Hey everybody, Andy Moss here, tradingadventures.com, and it's Saturday, which means it's time for a trip through the weekly charts. Let's take a look at the market action over the last 5 to 7 days and see what happened to those cracks we've been pointing out for a couple of weeks now, noting some potentially troubling signs beneath the surface that developed into very visible signs of downward pressure last week and got some continuation this week. So starting here with the S&P 500, there we are, down to the 200-day moving average, below the anchor off the breakout in June, touching the 200-day moving average here and closing on the lows. A little bit of a rally attempt up here was stopped short at the middle of the Bollinger bands and the declining 4-week moving average there. So that's your look at the S&P. Here's the SPY, just for reference, not quite to the 200-day, but you get the idea. Qs, something very notable here on the Qs. Look at all the upper shadows on these recent candles, this one notwithstanding. Every single rally attempt has pushed it back down, and very small real bodies on the last 3 weeks, which I don't know that has any significance. Just interesting little curiosities that jump out at me from time to time. RSI is below the 50% level here. Volume average on the Qs. DIA, more of the same. Failed breakout, loss of leadership, decline through all of the on this trip lower, and now we'll have to wait and find out, is the 200-day, or excuse me, the 40-week relevant? Maybe it is, maybe it isn't. I'm not wild about the fact that prices just dripped lower all day Friday into the close, and even went down a little bit after hours there. So on the futures have, just let me show you that here real quick. On the ES futures, this little bit of a runoff here as they close up the market, just taking it down a little bit further there. So again, not terribly significant maybe, but just a curiosity that jumps out at me from time to time. And so there's the Dow. Then finally we go over to the Russell 2000. This breakout anchored VWAP, again, that's from the June move higher and up more and more persistently, and now here we are down below the middle of the Bollinger Bands. RSI below 50%. Volume is above average as the selling picks up some intensity there. Moving on down through the list, Bitcoin, maybe somewhat oddly, gets a bit of a rally this week, as this level in here, 65,000 and change, has maybe had a little support. Last week's attempt to get over this anchored VWAP from this bit of a failed breakout here is rejected hardly, and now we get a little bit of resumption back in the upward direction there. So it touched this level again, and you can see here's a previous low, also around 74,000. So those levels here conspiring to kind of keep on the lid on the price right now, but it's holding in there pretty good so far over the weekend. We'll have to see what happens with Bitcoin, and on the dollar also finding some strength. We've noted this kind of choppy consolidation range here for many months now, and almost a year actually since it's been in this range from 174 to 96, call it roughly speaking, and right back to the anchored VWAP from the high in January of last year. So that will be a test. We've got some previous highs right in that area here, and is it more chop and continuation along this sideways channel, or can it continue some strength and break out into new territory there? Two possibilities we can watch for on the dollar. XXUS, and more, maybe not dramatic, but pretty pronounced selling here. The rally attempt was squashed all the way back down to the breakout, or excuse me, the anchor from this. This is consistent with the breakout moves on the US indices. Not much of a breakout candle there, but it was a meaningful event in the markets. That's why that anchor is there. RSI back down to 50%, and really big volume on the overseas markets in the ACWX there. So We'll see how that develops, but selling pressure intensified within the ranges of last week's sell-off, but it's still very dangerous looking here. Below all the moving averages, outside the lower Bollinger Band, RSI weak, volume in line. Nothing to be excited about from a long perspective on China. This could chop around for a couple more weeks or continue on lower. We've got some Fibonacci levels on here that maybe are relevant. Well, we won't know until after. But bonds, not pretty. Breakdown of this trend line, failed breakout move here, if you want to call it that, and just more pronounced selling in bonds. So just with Bitcoin aside, it looks like pretty much, or so far anyway, looks like pretty much everything was getting liquidated last week. That was the aggregate bond index. Here's the treasury bond index. More selling there. High yield bonds, more sellings at least almost across the board here. GSG, the commodity index, we know this is very heavily weighted towards oil, so not surprising it held up very well and made a new weekly closing high for this time frame. I can expand the chart out here a little bit, and let's see, is that maybe that's another new all-time closing high on this index? It sure looks like it. I'm not going to go back to the beginning of time to verify that, but I believe that to be correct. Crude oil specifically, just incredible range. I mean, my goodness, what is this? That's a oil in 1 week. Just unheard of. RSI nearly 84, volume massive again for the second week in a row. Is that a sign of a smooth and orderly market? Maybe not. So we'll see what happens with oil. Certainly no shortage of headline news and risk there to keep that market jumping. Moving on to gold. This one actually looks pretty orderly. Moving average here and still above a 10-week, well within the bands of the reaches of the upper Bollinger Band there. RSI still strong. Volume backing off just a little bit, but no concerns there for gold yet. Silver, more of the same, and maybe a little deeper sell-off here. Kind of a consolidation pattern here. It wouldn't surprise me to see a trip, not trading on that, not betting on that, but that just kind of seems to be what the pattern suggested. The other alternative might be a trip back up into this range and then some consolidation before it tries to find a more directional resolution there. You still see the consolidation here, touch to moving average. RSI is easing up a little bit. And remember, once again, the pattern seems to be the first test gets a second test. We've seen that on the low end up here a couple of times. We've seen it on the high end several times. And so that's what I've mentioned for the last few weeks is maybe this is not the end of the current decline for this relationship. Just to remind you again, IWD is the value portion of the Russell 1000. IWF is the growth value. So what we're seeing of value, looking at consumer discretionary versus consumer staples. More, if this were a stock chart, we'd say this is a bearish consolidation pattern. Yes, the 4-week moving average, that little thin black line, has flattened out, but this is below the moving averages, pointing lower, and looks like bearish consolidation that would likely lead to further downside. Again, not a prediction, just looking at the price action as we see people continue to shift from discretionary sectors into the more staples, the more necessities of day-to-day life. High beta versus low volatility, still moving in favor of low volatility. So all of these, the reason we look at any of these relative, or the reason that I'm looking at these relative strength relationships is as a potential indication of a risk on versus risk off attitude. And so my interpretation of this is that people are getting more defensive. We've already seen gold, we've seen oil, we see bonds selling off and the dollar going up. These are all indications of people and portfolio managers and traders and all the market participants getting more cautious, more defensive, moving further toward a position of perceived safety and away from risk on allocations. Down into some individual sectors, the SOXX, the semiconductor index, a little bit of strength here this week, not changing the overall picture is still a decline in an uptrend. It did test the middle of the Bollinger Bands here. RSI didn't even get down to 50, so holding up really pretty well there on the semiconductors. But notice it did try to test this declining 4-week and the still rising 10-week, and it couldn't get above it. So a little resistance there. Maybe we'll see how that resolves. Moving on to XBI, the biotech ETF. Again, an attempted rally here. It still looks pretty strong overall. I mean, this is a high-level consolidation in an uptrend. There's no material breakdown yet in the biotechs, but more selling coming in and driving prices lower. It's trying to hold this anchored volume weighted average price from this bit of a dip back here in November, and really not a lot of reference points between this level around 121.68, and we've got the lower Bollinger Band down here around 112, and then the rising 40-week moving average just below 107, and then of course this level back at about the mid 103s. So if we lose this area below 121 to 120 next week, that would likely open up further downside for XBI, but we'll have to wait and see how that progresses. The software rally took a break. Is it over? Who knows? It's inside week here in the upper ranges of this big breakout candle, not breakout, but this big green candle here from 2 weeks ago. And holding this anchor once again, which goes way back to October of 2022. So no resolution there, no directional indication for IGV other than it's just taking a break after what was a very big 2-week rally that we noted to be on lookout for back in mid to late February. I want to go over here to XLF and add this chart in. We do have a DeMark 9 buy setup printing this week, so that's not a signal, that's just context. Maybe we can be on the lookout for a bit of a bounce in the financial sector next week, but a couple things going against that. RSI is not at extreme levels. It's not oversold. The Bollinger Bands are opening wider. We closed on the lows. It's below this Fibonacci extension level here, and really wouldn't surprise me to see more downside ahead in the financials next week. But again, not a prediction, just looking at the price action. We'll see what happens with that. And then let's compare that to the energy sector. Two very different looking charts there. No surprise, energy names going up very strongly and persistently as oil does what it does. So Mag 7, just continued weakness. It's the rally attempts like we saw in the indices, can't hold, pushed back down, actually closed below this orange line, this anchor from the April 7th lows, and looks like it wants to continue lower. It's got plenty of room on the RSI. Volume still continues to be above average, and no one is rushing out to do any meaningful buying in the Mag 7 names. And now we'll take a look at market breadth and participation as I like to review them. This is the percentage of S&P 500 stocks above a 50 and a 200-day moving average. And we pointed out last week it's getting close to this or below the 50% level. And so this is where we start paying a little more attention. He's continued to hold up very well. Within the indices was actually holding up very well. Despite the weakness we'd seen in many specific sectors and areas, all of this looked pretty good. And so this looks like kind of the last thing to go now. S&P 500 price, again, down to the rising 40-week moving average. And we see the percentage of individual stocks in this index above a 50-day moving average is now down near 30. Sharp, steady decline here over the last few weeks. Over the 200-day is down below the 50% level. And these really washed out areas are, if there's a signal to be drawn from this at all, it tends to come from the extreme areas. And sometimes they indicate a bounce in uptrends. We can see that maybe a hold at the 50% level or the below 30% level. In the extreme readings to the upside tend to resolve through time. That's what we've seen recently. So again, no way to know what's going to happen next, but we're just looking at the actual data and seeing that there's far fewer S&P 500 stocks in intermediate and long-term uptrends now as there was just a few weeks ago. So seeing the breakdowns there beneath the surface and looking at the point and figure charts now for another view of similar information. Here is the S&P 500 bullish percent index now in bear confirmed status, which just means we've got a sell signal on the point and figure chart here as this column progressed deeply lower down around 43, not yet added another O for that 43 box, but this is a steady decline, a pretty pronounced decline over last week, and that tells us that just like fewer stocks in that index are above a 50 and 200-day moving average, now even fewer are showing a point and figure buy signal on their individual charts, the individual point and figure charts there. So I'll put links in the description or in the show notes here to the articles I've written more about what these indices are, how they measure, and why I find them useful. So be sure and take a look at that. I had some questions about that again in the last day or so. So please take a look there for more information. Here is the NASDAQ 100 bullish percent, also in bear confirmed status, down below the 50% level. So we're getting fewer NASDAQ 100 stocks on a point and figure buy signal. And the NYSE bullish percent, this is still a bull correction, but notice here, this O is even with this one right here in 4044 level, and we're down near 4302. So if we add another O here, that will technically change to a bear confirmed status like the S&P, like the NASDAQ. Not that that means anything. That's not a buy or a sell signal. That's just the terminology assigned to the different chart status on these bullish percent indices. So again, the data is the same. It's telling us that fewer charts on the NYSE are showing a point and figure buy signal. So what does that all mean? Last week, just to continue the sequence, we were seeing loss of leadership across the indices, weakening participation, international markets rolling over, high yield bonds and investment grade bonds breaking down, signaling some potential risk there. And this week, we see more of that. The selling is continuing. The tensions in the news cycle is adding to those anxieties. And once again, market participants continue to position more defensively as we see a rise in gold, lots of erratic action in crude and the dollar, while the more risk-on asset classes continue to decline. So the really notable thing is we're not at washed out levels. We're not at extreme levels. RSI on the S&P is still near the 50% level, although it is below a little bit. And don't be fooled into thinking that there's some kind of magical support at the 40-week or 200-day moving average. It is a level of reference, but it doesn't mean we have to bounce next week. Maybe we do, maybe we don't. But right now, the market is in a more bearish configuration than it has been in quite some time. That's not a reason to panic. That's not a reason to say we're going down much, much further. It is what it is, and we just have to be observers and try to listen to the message of the market. And that message right now is, and has been for a while, go slow, be patient, do less. This is not a prime setup or environment for long-oriented swing trading. Maybe we get an opportunity to buy cheaper for better swing trades or better long-term positioning, but right now, so far, doesn't appear to be that time. For another piece of context here, looking at the move from the highs, I don't know why it's not working there. Again, looking at that move off the highs, the S&P is only down a little more than 5% from the highs. So this is not catastrophe. This is not doom and gloom or panic situation. And we've got a long way to go if we're to get to that level. People love to call it a bull market or a bear market, or say we've had a correction or that kind of thing. And I don't believe that any of that really matters all that much. But just because it gets mentioned and examined so often, a true correction by the commonly used definition on the S&P 500 would be a 10% move, which takes us down around 6,300. A bear market would have to go way down here to about 5,600. So I'm not saying we're going there. I'm just saying that is the terminology that the pundits and the talking heads love to point out, and we're nowhere near that yet. If we consider the Qs, it is more of the same. If we take this high, and these are not closing highs, those are kind of the intra-week all-time highs. We're down a little more, about little more than 7% on the Qs. If we go back to this level, it was not quite 9%. A 10% correction, again, as they like to say, would have us just this anchored VWAP off of the June lows, or excuse me, the April lows back there in 2025. And 20% would be way down here around 5. Did briefly touch the area of a 10% decline, about just barely over that number here as it approached the anchored VWAP, the orange line you can see right there, this orange line. So it doesn't matter. It's just, I just pointed out for reference and a little bit of added context. So there's where we stand on the major indices, the different macro asset classes and potential risk parameters around the world. And we'll have to see what happens next, just same as every week. We don't know what's coming. We just read the price action and listen to the message of the market. So once again, that says to me, go slow, take it easy, don't be in a rush, don't try to be a hero and start loading up on big opportunities or perceived opportunities to buy things just because they're cheaper, because cheaper can get still cheaper and still cheaper and still cheaper, and maybe we have a bounce as well. So we're just going to have to stay tuned, stay patient, and read the price action. Looking into next week on the calendar, things that could potentially impact or influence those market moves, we've got some employment data coming on Tuesday, some home data and that kind of thing. But the real potential market movers will be PPI on Wednesday morning at 8:30, and then we've got FOMC rate decision on Wednesday, March 18th at 2 p.m. So those are the two potentially big impact announcements or economic data next week. And then we've got jobless claims and mortgage data and kind of the normal stuff there. So that's what we'll be looking for, or not looking for, but just know that they're on the calendar, know that they're coming. There's not a lot of earnings reports next week, I don't believe. Nothing that I've seen, headline names or any of that kind of stuff so far anyway. So just be cautious, go slow, manage your risk, and we will keep you updated as always.